Good morning.
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 Good morning. I hope y'all aren't as sleepyheads as my 8 o'clock class was. Oh my gosh. It was like pulling teeth to get them to say something. And this is the last Tuesday that we get to meet. And then Thursday, and then we have exam. Let me get into some housekeeping stuff first, some administrative stuff. I uploaded into either Friday or Saturday, I don't remember which one. I uploaded an interest capitalization problem for y'all to work. I think it was Colby. Has anybody seen it? I uploaded it Friday or Saturday. Remember, I told y'all that I would have some practice problems for you to, that I would upload some practice problems. So uploaded practice problems for interest capitalization. I also uploaded that we're going to use today some chapter 11 notes. All right, there are 3 files in course content information that are the notes for understanding how to dispose of assets. And then there are 2 sheets. One is the problem that shows the journal entry. Then one is the Excel file that shows how I calculated the number for when we dispose of assets. So those 3 sheets are specifically related to disposal of assets. When we look at chapter 11, oh wait, let me finish with the administrative stuff. Don't forget to send me when you complete the faculty evaluation, forward me your participation sheet, your participation, thank you for participating, because that's part of your participation extra credit stuff. So make sure that you complete it thoughtfully, and then forward me the participation. I'm keeping an Excel sheet on who completed them. Again, I don't see the results at all. Yeah. Just the name that you completed it. And so forward that to me. So I want that housekeeping also. I started preparing the exam. I spent 5 hours yesterday and I got chapter 8. Look, y'all don't know how long it takes to prepare exams. It just is incredible. I spent 5 hours yesterday and I got 1 chapter done out of the 4, chapter 8, that will be included in it. Now, the amount of time that I spend doing it doesn't impact the length of it or anything. It's just putting in those thoughtful questions. Since the exam is online, I want to make sure that I'm exposing you to the way that it is worded online, versus the way that I do practice problems and then would do on the exams that I write. So when I did the topical coverage, that's another thing that I uploaded, is the exam coverage for chapter 3. I uploaded also, as I promised you that I would, is uploaded also. If I need to do any tweaking to it because of preparing the exam now and seeing how it's done, worded online, I will. So working on that. Oh, I am going to be uploading a problem. I've already written it. Now I'm working on the solution of disposal of assets so that you again have problems with working on that. Now, with respect to chapter 11, to understand what we're covering in it, if you look at the chapter 11, if you look at the exam topical coverage, you will see the topics in Chapter 11 that we will be covering between today and Thursday. I'm hoping to get most of it covered today, but we didn't get as much covered as I wanted to in the 8 o'clock class because they were sleepyheads, like they hadn't even heard of accounting at all. So if we do that, it slows it down and I won't be able to get everything covered that you're responsible for. The day before your exam, I will have just open office hours, and I will send out the Zoom meeting, link and the date and the time, but it'll be the day before your exam. I'm going to have office hours. I believe y'all's exam is on that Thursday and is on a Thursday instead of the Tuesday. And my 202 has an exam on that day also. So I will have 2 sets of office hours so that in one Zoom meeting, I don't have 202 questions and 320 questions. So I'll have office hours just for 320 the day before your exam.
So our exam's on Thursday of next week?
I thought it was on Tuesday, May 5th, 11 to 1 p.m.
Actually, I do know. Let me see right here.
I could be wrong, but that's what I thought.
It is. It is. All right. So y'all's exam is on Tuesday the 5th. So from 11 to 1. So on May 4th, I will have office hours for you. It's the 8 o'clock class that has it on Thursday along with the 202. So y'all will have office hours on May 4th. And I will just have open office hours where you can come and, come in and leave after you get your questions answered. Does anybody else have any questions, or if I missed something about how we're going to end things up? AS2 is due on Thursday. Does anybody have do I need to set up office hours just specifically on AS2? All right, you can email me your questions. I think most people are figuring out AS2 and getting that done. Okay. All right. The first thing that I want to cover in Chapter 11 is understanding. I don't want to take precious class time of calculating depreciation. There are 2 depreciation methods that you need to understand or know how to calculate. And what are they?
Straight line.
Good. Straight line and
Graded.
Double declining balance.
Okay, that was echoing units of activity. Okay. Right. You do not need to know sum of the year's digits, which is crazy. I've never seen that used in practice. I don't even know why it's still in textbooks. And declining balance. Now that is used, but it's not used as much as straight line. So with online, I had to cut something out, and you're not going to lose a whole lot by not learning declining balance. So straight line and units of activity. Now, with respect to depreciation, there's some terminology that we need to understand in our application and in our let me find the sheet that I had. So I want you to learn some terminology. So I'm going to share screen right now. And this, can everybody see that screen? This was one that I was typing as I was saying it in the 8 o'clock class. So instead of retyping it, let's go over each of the concepts that.
You can only see like the heading.
Yeah, only the top.
Like I can't see the whole page.
Interesting. Well, let me try this again. Share screen.
Same thing.
Same thing. Well, where's my share screen? What do you see now?
I mean, personally, I still just see like home, insert, draw, design. Like I don't see the rest of it.
All righty. Well, it's up. Totally up. I'm looking at it. And share screen again.
There you go.
No, it's better. You can see it now.
What do y'all see?
I see your
Desktop.
inside. That's top screen.
What do y'all
There
see
you go.
now? Y'all see cost allocation?
Yeah.
Okay.
Yeah.
All right. So I want to describe these terms and let's talk about the terms. And then if you want to, instead of writing the notes, if you want to take a picture of these notes, that's fine also. Cost allocation. We know that depreciation is cost allocation for tangible assets. What do we call it for definite life intangibles?
Oh,
Amortization.
Amortization, good. And what do we call it for natural resources? Depletion, good. So those are the cost allocation methods that we're doing. One of the things that I want, and we're going to do them straight line and units of activity, is how we're going to calculate them. Now, cost allocation is simply allocating the cost of a long-term asset over its useful life. Its cost. Depreciation, amortization, and depletion has nothing to do with the fair value of the asset. Nothing at all. We purchased a piece of property, we purchased equipment for $100,000. And the residual life is $10,000. In other words, at the end of its useful life, I expect that I'll be able to sell it for $10,000. What is the ultimate cost of that equipment to me?
$90,000.
$90,000, exactly. I paid 100. At the end of its useful life, I think I can get 10. So the amount that needs to be allocated, the cost that needs to be allocated over the useful life is what we call the allocation base. Okay. So we're allocating the cost of the asset over its useful life. The useful life is the length of time that the long-term asset will produce revenue. And again, cost allocation has nothing to do with the fair value of the asset. All we're doing is allocating the cost of that asset over the time period that it's producing revenue. So what is the amount that will be allocated over the long-term asset's useful life?
The allocation base.
Exactly, the allocation base. And how do we define the allocation base?
Capital cost minus residual value.
Good, cost minus residual value. Cost minus residual value. That's the amount that I'm going to allocate. That's the ultimate cost of the asset to me. Now here's a rule that I want you to clearly understand. We can never depreciate more than the allocation base of a long-term asset. Right, Josh?
Yep.
Josh was working ahead in Chapter 11 Connect and had this question over this weekend for me, I think on Sunday, and we were able to get through it. But we can never depreciate more than the allocation base of a long-term asset. In other words, the book value of the asset cannot be lower than the residual value. The book value cannot be lower than the residual value. So we cannot depreciate more than the allocation base. Look at, before we finish the terminology, look at page 578. On page 578, and I know this is the last week of class, and I've been begging all semester long to critically read these chapters. And when you critically read the chapter, were you able to calculate where that 24,000 in illustration 11.3D came from? Why was it 24,000?
It's whatever's left to get it to the residual value.
Good, whatever is left to get to its residual value. How many units had they produced in year 5?
26,000.
26,000. What was calculated as the per unit cost?
$1.50.
$1.50. Everybody put 26,000 times $1.50 into your calculator. So what is 26,000 times $1.50?
39,000.
So 26,000 times $1.50 is 39,000. But they only took $24,000 of depreciation. What was the residual value? How much did they pay for this asset? What was the cost of this asset?
200. They paid 250,000.
Good, they paid 250,000. Then what was the residual value?
40,000.
40,000. Okay. So the maximum amount of depreciation that they could take is 210,000. So the total accumulated depreciation for this asset should not be more than the allocation base, which also means that the book value cannot be lower than the residual value. How do we define book value? How is book value defined?
Cost minus accumulated depreciation.
Good. Cost minus accumulated depreciation. We're going to be using this concept again. So I could take 24,000 because the maximum depreciation expense, accumulated depreciation, cannot be more than 210,000, meaning that the book value cannot be less than the 40,000. So don't make sure that you don't have an OS moment with calculating that. You're going to see it in Connect, right, Josh?
Yeah, there's one problem where I thought you would just do like a straight line depreciation kind of thing. And then for the last one, you have to change the number to reflect the book value.
Right. Where this happens, in one of the Connect problems. So cannot depreciate below the residual value, right? So we know that book value is equal cost minus accumulated depreciation. This is the amount that's reported on the balance sheet. You learned in chapter 3, property, plant, and equipment, minus the accumulated depreciation equals the amount, the book value, which is the amount on the balance sheet. What kind of an account is accumulated depreciation?
A contra asset.
Good, a contra asset. Okay. Now, another thing with respect to depreciation that you need to understand is that in the year of acquisition and in the year of disposition, you will have partial year depreciation. So in the year of acquisition and in the year of disposition, you will have partial year depreciation. Let's take a look at, I think it was exercise 1123. That was change in estimate. 1111 maybe. Nope. Oh, wait. We've got partial year depreciation in that we can look at exercise 11.7. So look at exercise 11.7 on page 622. So I'm going to pull up an Excel sheet. Hopefully y'all see an Excel sheet. And let's take a look at exercise 11.7. I've got an asset that was purchased on March 31st of 2021. And the cost was $12 million. And so they purchased an office building based on their relative fair values. 1/3 of the purchase price was for land and 2/3 for the building. So land and building, we've got a lump sum purchase here that we need to allocate. So how much of it was for the land? 1/3?
Yeah.
And the remaining was for the building. So 800,000 would be for the building and 400,000 for the land. 4 million for the land and 8 million for the building. Furniture and fixtures were purchased separately from the office equipment on that same date for 1.2 million and 700,000 respectively. So I've got furniture and fixtures was purchased on the same date for 1 million, 1.2 million. And the equipment, office equipment was purchased for 700,000 on the same date, March 31st of 2021. The company uses straight line depreciation and the double declining method, straight line depreciation for its buildings, and then DDB, which we aren't going to learn, for all the other depreciable assets. And then it gave us what the estimated useful life and residual values were for each of the assets. So the residual value and the useful life and the useful life. And so the residual value on the land is nothing. And the residual value on the building is 10% of its cost. And let's just work the building since furniture and fixtures. I'll just do it using straight line depreciation instead of the DDB. So the furniture and fixtures, the residual value was also 10%. And the residual value on the office equipment is 30,000. And the useful life for the building was 30, furniture and fixtures was 10, and office equipment was 5. Now again, I'm going to use straight line, although it's said to use DDB for the furniture and fixtures and the office equipment. I'm going to go ahead and use straight line. So calculate depreciation for 2021 and 2022. So what would be my annual depreciation for each one of the assets? So what is my numerator for straight line depreciation?
The useful, no, the residual, the asset price, or the residual value.
Right, the cost.
Minus
So the
residual.
depreciable base, right? The allocation base is my numerator. So the allocation base is my numerator, which is the cost minus the residual value. And then what is my denominator?
The useful life.
The useful life. So my annual depreciation for each of the different types of asset is the building would be 240,000, the furniture and fixtures 108, and the office equipment 134. Make sure that you got the 134 in your calculator. I did it in Excel and just copied but make sure that you understand how that straight line depreciation is calculated. Now in year 2021, I've got partial year depreciation to take. When did I buy the assets? On what day?
31st.
Good, March 31st of 2021. So in 2021, how many months did I use each of the assets?
9.
9 months. So I'm going to take my annual depreciation, divide it by 12 to get monthly, and then times 9. So my annual depreciation for 2021 would be 180,000 for the building, and 81,000 for the furniture and fixtures, and 100,500 for the office equipment. Now, again, this is going to be different than what's in the solution manual, because the solution manual asks you to do DDB, and we're not going to do DDB. So make sure that in the year of acquisition that you take your partial year depreciation. Now, what would be my depreciation in 2022?
It'd be 240,000.
Good. It would be the full year's worth of depreciation for each of the assets. Okay. So in the year of acquisition and in the year of disposition, you've got annual depreciation to do. Partial year depreciation to calculate. In the year of acquisition, the amount that you will calculate will be from the date of acquisition to the end of the year. Okay, in the year of acquisition. In the year of disposition, it's going to be from the beginning of the year to the date of disposal. Okay, to the date of disposal. So these are concepts that when you are applying and calculating the amounts of your depreciation, and there are plenty of problems to practice this at the end of the chapter for straight line and units of activity, make sure that you're applying these principles that are on this page. Now, before we get into disposal of an asset, I want to get into what happens when we change depreciation assumptions. Depreciation has got a number of assumptions in it. Number one, we estimate what its useful life is going to be. We also estimate what its residual value is going to be. Well, what happens if those assumptions change while we're in the middle of depreciating and using this asset in the production of revenue? When we have a change in estimate, which begins on page 596 and 597, that when we have a change in estimate, we're going to handle it prospectively. That means we're going to handle it prospectively. You calculate what depreciation will be going forward from the date of change, and then just use that depreciation number going forward prospectively. So let's look at exercise 1111. No, maybe it is. Keep wanting to use, nope, 1122. 1123. So let's look at exercise. I worked so many of them at the 8 o'clock class. Let's look at exercise 1123 on page 625. 1123 on page 625. So 1123 on page 625. And I'm going to share screen with you. Yeah, I don't trust my share screen anymore. I don't blame you. And I think that's it. Do you see a share screen? Do you see an Excel file?
Yes.
Yes.
Okay. Now, this is what I typed when from the 8 o'clock class. So we've got an asset that we purchased on January 1st. So we know we don't have partial year depreciation to deal with, but we purchased an asset for $40,000 on January 1st using straight line depreciation. And we estimated that the useful life was 5 years. And the residual value was $4,000. So I want each of you to calculate what annual depreciation was. How did I get the $7,200? So put it in your calculator, make sure that you understand where that $7,200 of annual depreciation came from. What's my numerator?
36,000.
36,000, good, that's your allocation base. What is your denominator?
5.
5. So 36,000 divided by 5 should give you $7,200 a year. Now, on January 1st of 2021, they changed the estimates so that the useful life, instead of being 5 years, was going to be 10 years. And that the salvage value, of course, since they were using it for a longer period of time, was going to decrease to $900. Okay. So we purchased this asset on January 1st, 2019. And then on January 1st, 2021, after I'd taken 2 years of depreciation, we changed 2 of the estimates. So step number 1, calculate the book value as of the date of change. Calculate the book value as of the date of change.
21,600.
Right. So the book value as of the date of change would be 25,600. I had $7,200 of depreciation in 2019 because what day in 2019 did I buy it?
January 1st.
January 1st. So did I have partial year depreciation?
No.
No. And then I took a full year's worth of depreciation in 2020. So the total amount of depreciation that I had taken as of the date of change, January 1st, 2021, was $14,400. My book value as of the date of change, because that's what I'm trying to calculate. What is my book value as of the date of change? The cost was $40,000. My accumulated depreciation was the $14,400. So my book value as of the date of change was $25,600. So my book value as of the date of change is is 25,600. 824, well, is equal to that number. Oh, I know what I did. I just added. All right. So my book value as of the date of change is 25,600. Now, how many years did I estimate that the asset was going to last now?
Wasn't it 10 years?
Yeah, 10 years. Now be careful on wording here because it says that the estimated useful life was changed to a total of 10 years. if it said that it was changed to it had 10 years remaining, that changes the meaning of that sentence. So it said that the useful life was changed to a total of 10 years. A total of 10 years. So how many years, what am I doing here? So 25.6 is my book value. And oh, okay. The book value as of January 1st, 2021 is 25.6. And my 10 years is the number of years that this asset was going to be used, a total. How many years have I depreciated? How many years have I depreciated so far as of the date of change?
2.
2. So now my denominator for my useful life is 8.
Wait, so I had a question.
Sure.
With the 25.6, don't you still have to take out the new residual?
Yeah, we're going to do that. So I noticed that I had labeled this book value as of January 1st.
Okay.
Okay. So my book value is January 1st. So what would my new annual depreciation be? Well, my numerator is going to be the book value minus the new residual value divided by the remaining life of 8 years. So my new annual depreciation is $3,087.50. So calculate the book value as of the date of change, and then use the new assumptions. So that when I calculated my depreciation, my numerator is now going to be my numerator is 24,700. My denominator is 8. And if I take my numerator, new numerator divided by the remaining life, we get 3,087.50. Okay, so the book value minus the new residual value divided by the remaining estimated life. We had estimated that the total would be 10. We've already depreciated 2, is where the 8 came from. Okay. There are a number of problems where you can calculate a change in estimate. So practice those. Now, the next topic that I want to cover is about disposal of assets. The disposal of your assets. If you look in course content information, this is where I want you to bring up the sheets. Look at the sheet where it is the notes, where it says explain how to account for disposal of your long-term assets. And I gave you examples of how it was calculated, if it was sold, if it was retired, or if it was exchanged. So go through the examples that I have in that note page. But what I want to call your attention to is on the second page are the 4 steps for recording the disposal of an asset. And this will apply whether you are selling it, whether you are selling it, exchanging it, or retiring it. Okay? Do these 4 steps and stay out of trouble. Okay? Number 1, record depreciation up to the date of sale. Remember that partial year depreciation that we just talked about that you're going to have in the year of disposition. So if I sold an asset on October 1st, the last time that October 1st of 2022, the last time that that asset was depreciated was December 31st of 2021. So I would need to depreciate, if I sold it on October 1st, I would need to record depreciation for the first 9 months of the year that the asset was disposed of. So step 1, record your depreciation up to the date of sale. Step 2, calculate book value. Calculate book value. How do we calculate book value?
Cost minus accumulated depreciation.
Good. Cost minus accumulated depreciation. Then determine your gain or loss. You will read in the diamonds that I've given you, the bullets of information, that in order to determine a gain or loss, when you sell it, you compare it to your selling price. And if the selling price is greater than the book value, then do I have a gain or a loss?
That's a gain.
That's a gain, exactly. If the book value is, if the selling price is less than the book value, then I have a loss. Then we have a loss. If I'm exchanging it, then your gain or loss is going to be compared to the fair value of the asset that you're giving up. And then if we're retiring it, that means that you're throwing it in the junk pile and you're getting nothing. So you're going to have a loss or no gain or loss, depending on what the book value is. When you retire it, your loss is going to equal your book value. If you had no residual value and you have fully depreciated the asset, then what is your book value? 0, exactly. And you wouldn't have any gain or loss. So let's look at that example sheet. Pull up the example sheet that I have given you. And there's 2. One is where I've got the journal entries, and the other one is the Excel file where I show you the calculations of how the numbers were calculated. So I'm going to share file with you, hopefully. And I've got so many Excel files up. We got to find which one it is. There it is. All right, so I'm going to share screen. All right, do you see that?
Yeah.
Okay.
Yeah.
All right, so this is the sheet, and this is where I worked a problem where on May 1st of 2017, Bostic purchased a sail loft for $750,000 and estimated that the loft would have a useful life of 20 years and a residual value of $200,000 straight line depreciation. Now, on November 1st of 2020, Bostic sold the loft for $630,000. So step number one is what? Let's follow the 4 steps. What is step number one?
Record depreciation.
Good. Record depreciation. Look at that sheet that I gave you. Know those steps. Step one, record depreciation up to the date of sale. So I want each of you calculating, how did I calculate the 22,916.67? Where did that number come from? So calculate the 22,916.67, remembering partial year depreciation in the year of disposition. Okay, I'll be right back. How'd you get it? Take an aspirin. So how did we get the 22,916.67?
You take the allocation base,
Okay,
which is
what the allocation base is how much?
550,000
Okay, good. 550,000.
divided by 20 useful years.
Good, divided by the 20 useful years.
So your accumulated depreciation every year would be 27,500.
Right, so 27,500 would be a full year's worth of depreciation. Good. Everybody could be putting this in the calculator. David's doing a good job of bringing you through.
And this year you sold the asset after only 10 years have gone by. So you didn't incur depreciation expense for the whole year. You only incurred it for 10 of the 12 months. Sorry.
10 months, right?
Yeah, there was something with my internet connection. But yeah, so 10 months is 10 over 12 times the yearly depreciation, which is 27,500, and that's 22,916.67.
Perfect. Thank you, David. So did everybody get that the annual depreciation is 27,500? Divide that by 12, multiply it by 9. Where did the 9 come from?
I think it's 10.
10, sorry. Where did the 10 come from?
From how many months you used it for that month, for that year?
Good address for how many months that we had in 2020. In 2020, I sold it on November 1st. So I used it during 10 months. So if 27,500 is my annual depreciation, divide by 12, multiply by 10, will give you your partial year depreciation. So debit depreciation expense and credit accumulated depreciation to record your partial year depreciation in the year of disposition. Okay. Now, where did I get the numbers in order to do the journal entry to sell the asset? I'm going to stop sharing and share screen again with the Excel. And let me bring up the right Excel file, which I don't have. Why not? Great. All right, can you see this Excel file?
Yes.
You can? Woohoo, success. All right, so we had the loft that cost $750,000, and it had a residual value of $200,000. So my allocation base, my depreciable base is $550,000 and 20-year life. And as David said, we had the depreciation each year of $27,500. Now I want to know, as of the date of sale, what is the book value? Step 2. Step 2 says calculate the book value. So book value is cost minus accumulated depreciation. So I need to know, what is the balance of my accumulated depreciation as of November 1st, 2020? Now, when did I purchase the loft? When did Bostic purchase the asset?
May 1st,
May 1st of
17.
2017. So how much, remember, when is partial year depreciation taken in what years? Nelson, what years are they taken?
Isn't it 2018 through 2020?
Or 2017 and 2020. In the year of acquisition and in the year of disposition, we have partial year depreciation.
Yeah.
So I acquired it in 2017. How many months of depreciation do I take in 2017?
8 months.
8 months. We purchased it on May 1st, was it?
Yeah.
So May 1st. So if I purchased it on May 1st, then I had it for May, June, July, August, September, October, November, December. 8 months. So what is 27,500 divided by 12 times 8? So in 2017, I took 18,333.33 of depreciation. Then in 18 and 19, I took the full year of depreciation. And then we had already calculated the depreciation for year 2020, the 10 months. So my accumulated depreciation is 96,250. So what is my book value as of the date of sale? What is the book value as of the date of sale? Lillian, what's the book value as the date of sale? Stephen. Stephen, what's my book value as the date of sale? Well, how do we define book value, Stephen?
The original cost,
Good, original cost, which was how much?
$750.
Okay, good, 750 minus what?
The residual value,
Well, cost minus residual value gives me the allocation base. What gives me book value? What do I subtract from original cost?
Accumulated depreciation.
accumulated depreciation,
Good, accumulated depreciation. So what was accumulated depreciation, Stephen, on the date of sale?
is it the 96,250?
Perfect, the 96,250. So what is the book value as of the date of sale?
653,750.
Nice job. So if the cost was 750,000 My accumulated depreciation is 96,250. The book value is 653,750. So now I've done step 2. I've calculated the book value. Now what do I need to do? What is step 3? What is step 3?
Determine the gain or loss.
Okay, good. Calculate the gain or loss. And when I sell something, what am I going to compare to the book value to determine the gain or loss?
Selling price.
Good, the selling price. The selling price was how much?
630,000.
630. What was the book value?
653,750.
653,750. So do I have a gain or a loss?
Loss.
A loss because the selling price is lower than the book value, and the loss is for the difference. So I have a loss of 23,750. Everybody good on the calculation? So we've done step 1, step 2, and step 3. And step 4 is do the journal entry. So I'm going to go back to the Word document. Can you see that?
Yeah.
Okay, so let's go back to the Word document. And the journal entry, record what you got. Record what you got. What did I get? So I sold this asset and I gave them the loft. And what did they give me in exchange for the loft?
You got cash.
They got cash of 630,000. Okay. Now I need to get out of the general ledger the loft. I no longer have the loft, so I need to get it out of my general ledger. Now remember, that loft is sitting in 2 accounts because the book value is the cost, which is the building of 750,000. So I'm going to credit it. And then minus accumulated depreciation. Accumulated depreciation, what kind of an account did we say it was?
Contra asset.
A contra asset. So if it has a contra asset, if it is a contra asset, then what balance does it have? A debit or a credit?
Credit.
A credit. So how am I going to get it to 0?
Debit.
Debit it. So what was the balance in my accumulated depreciation as of the date of sale?
96,250.
96,250. So debit accumulated depreciation, 96,250. Now I have removed the book value out of the general ledger, and then I record the gain or the loss. Why is a loss debited? Why did I debit the loss instead of crediting it?
Because it doesn't have to, both have the debits and the credits have to add up. So if you credit it, credit wouldn't make it add up. If you did it, but the debit makes it add up to the 750 totals.
Okay, that's a principal student explanation in that, yes, that journal entry has to balance. But what a debit, a loss is similar to what kind of an account?
It's
in,
like
in the beginning
it's
of the
an
year,
equity account.
the elements, what element is it joined with? David, you were there.
Is it
Yeah,
retained earnings?
Yeah,
Right.
it's an equity account.
Well, it's going to change equity exactly, but what element?
Expenses.
Expenses, good. Remember, losses go with expenses and gains go with revenues. How do we increase expenses?
With a debit.
With a debit. So how are we going to increase a loss?
With a debit.
With a debit. Okay, so now we're going to debit the loss of 23,750, of which, yes, whoever said that does make my journal entry balance, but I want you understanding the number.
It's like recording an expense, and like recording a gain is like recording revenue.
Exactly. Exactly.
So
Okay.
could you do expense on sale of PPE, or is it always going to be?
No, because remember when we learned the elements, what was the difference between an expense and a loss?
Expenses are incurred in the normal operation.
Exactly. Expenses occurred during the normal operations, and loss were things that were just on the periphery of the company. There were peripheral activities. Is this company in the business of selling its sale loft?
No.
Do you know what a sale loft is? Anybody know what a sale loft is?
Like I don't know, it goes on a boat or whatever if you're sailing, like the
A sale loft is a building in which they make sales.
oh.
Not S-A-L-E, but S-A-I-Ls. So a sale loft is what we call that big building where sales are cut and sewn and made. Okay, so here's the journal entry right here to record the sale of the loft. What did I get? Cash. What do I no longer have? The loft, which is in two accounts. The cost account, the building credit of 750, and then its related accumulated depreciation. Then record your gain or loss, a debit for a loss, a credit for a gain, and then your journal entry should balance. Now let's take a look at an exchange. Okay, now let's take a look at an exchange, and we'll talk about the with commercial substance and the without commercial substance in chapter 10 in just a minute. Before we go into this, I want to send out a couple of polling questions. And let's see how we do on this one. All right, I'll give you about 20 seconds. I'm chewing ice. Sorry, that's an obnoxious habit. Okay, 5, 4, 3, 2, 1. And the assets capitalized cost minus residual value is what is the allocation base. Okay. The allocation base is a specific definition that you see on page 573. Remember, the allocation base is the depreciable, is cost minus the residual value. The number of years is the the denominator, okay? That allocation base is your numerator. The number of years is your denominator, okay? I'm going to send out another poll. And it's going to say C number 77. You know, I've got very limited space on the questions here. So let me bring up question number 77. I may have to end this.
It's showing just the heading again.
Yeah, I need to bring up the I've got so many, well, it shouldn't have that many files open.
My polling question just disappeared. Is it supposed to because you're doing something?
Yeah, it's doing because I'm doing something.
Oh, okay.
So look at number 77. And now I'm going to share the screen again, and it's going to have okay, there's number 77. And then I'm going to send out the polling question again.
All I see is the heading. Sorry.
I want to see the heading too.
So aggravating.
We could take a screenshot of the question.
No, I get it. I got it up there, but on the, okay, and.
It's still the heading.
Okay, what do you see now?
The heading.
Oh, shit.
Yeah.
All right. I'm going to just close some of these Word files. Oh, come on, Word files. Just. All right. Sorry about this. All right, that's what's up. The right thing, share file. I see it very clearly. All right, do y'all see that?
No, it's the same thing.
Why? I don't understand. This is just not making me happy, as you can tell.
We see your desktop now.
Oh, that's cool. What do you see?
Now we see the question.
Yay! All right, now. Now, do you see the
Yep.
cool beans? All right, sorry about that. So this one is about a change in an estimate, making sure that you understand how to change an estimate. I like these polling questions because it gives you, like after we've talked about it, some practice at it.
This is the type of question that's going to be on the exam.
Yeah, I mean, it's a change in estimate question.
Okay.
So I don't know how, yeah. And that's one of the things, you know, it's in the topical coverage, you know, that change in estimate. I'm gonna give you 45 more seconds. All right, I'm going to go ahead and close the poll. And 126,000 is the correct answer. So let's see how we got the 126,000. What would be the depreciable base of this asset? What is the depreciable base of this asset?
450.
Right, 450,000. Because the cost is 450,000. What did it say the residual value was?
0.
0. So we know that the allocation base is 450,000. The depreciable base, allocation base, the same thing. And how many units of production did they estimate they would get? What was the initial estimate?
300,000.
What was it?
300,000.
Good, 300,000. So then what would be the cost per unit? What is it?
1.5.
Good, 1.5, $1.50 a unit. Now, when did they purchase the asset in 2021? And when did they change the estimate?
Yeah,
2022.
Good, at the beginning of 2022. So how many years of depreciation had they taken at the time they decided to change the estimate?
1 year.
Just 1 year, good. So what was the depreciation that they had taken for that 1 year? $36,000. So what is the book value of the asset as of the date of change?
414,000.
Good, 414,000. Say it loud and proud. So 414,000, remember, when there's a change in estimate, calculate the book value as of the date of change. So my book value is 414,000. Now this one, it says engineers estimate that the machine can only produce another 230 units. So I'm going to take the 414,000, the book value, and divide it by how many units do they expect it's going to produce now? How many remaining units?
230.
230. So if I take the 414,000 and divide it by the 230, now what is my cost per unit?
1.8.
1.8. How many units did I produce in 2022?
70,000.
70,000. What is 1.8 times 70,000?
126.
126,000. Okay, 126,000. Now let me ask a question. In 2021, what day did they buy the equipment?
June 30th.
On June 30th. Why did I just take $1.50, which was the 450,000 divided by the 300,000? Why did I just take $1.50 times 24,000? Why didn't I have to multiply it by 6/12?
Because it's an activity driver based, not off the year.
Good. It's an activity driver. That's a beautiful way of putting it. Okay. If I had purchased it earlier in 2021, I would have been able to produce more than 24,000 units. Okay. So it's based on the actual number of units that were produced. Now in straight line, because it's a function of time, I would have had to take into consideration the time value of, the time, the 6/12. Okay, so good job on the 126,000. Now let's take a look at the other disposals, the remaining disposal of an exchange. And I had, because of the issues with all right, let's see if I know how to share a screen now. Can y'all see the disposal of long-term asset?
Yeah.
Oh, beautiful, yay. So now let's take a look at an exchange of the loft. So on November 1st, this is an independent situation. So on November 1st, the same day that, when we had calculated that she had sold it, on November 1st, Bostic exchanged the loft for another building because it's in a better location. The fair value of the loft was $630,000. And the fair value of the new building that I got is $700,000. Okay, is $700,000. So let's see. The gain or loss on an exchange is you compare the fair value of the asset that you're giving up to the book value. To the book value. Okay. We had already done this in that the amount that we had sold it for was 630. So I used the same amount as the fair value of the asset. So what was the amount of the gain or the loss that we had if the fair value of the asset that I'm giving up, the loft that I have, is 630,000, what was the book value of the loft? What was the book value of the loft? Go to that Excel file that we had. And what was the book value of the loft?
653, 750.
Good, 653, 750. It was the 750,000 minus the 96,250 cost minus the accumulated depreciation gave me the book value of that 653 number. If the fair value of the asset is 630, then I have a loss of 23,750. Does everybody understand that without me going back into the Excel file? Hello?
Yeah.
Yeah.
All right, so let's take a look at the journal entry. What did I get? So I exchanged my old loft, I exchanged my old building for a new
This is,
building.
sorry, is this all based on like the same like buildings?
Yeah, this is the
Okay.
same. Right, it's the same information. I said prepare all the journal entries for the 3 independent situations using this information. So what did I get? I exchanged my loft for a new loft. What did I get?
A new.
I got a new building, right?
Mhm.
And what was the fair value of the new building?
700,000.
700,000. So I debit my new building for 700,000. What don't I have?
Your old building?
The old loft, right? So we credit the building for 750 and debit accumulated depreciation for the 96,250. And we had calculated that I had a loss on the exchange of 23,750. The difference between the 630,000 and the book value of the loss of the loft. So the fair value of the loft compared to the book value of the loft. So I had a loss of 23,750. Now, where did this cash of 700,000 come from?
Because you need to come up with the remaining amount of the new building because your building isn't worth as much as a new building.
Exactly. The building that I gave up was worth $70,000 less than the building that I acquired. I got a building that was worth 700,000, but I gave up a building that was worth 630,000. Well, the person that is exchanging buildings with me isn't going to take a $630,000 building when they're giving me a $700,000 building unless I give them 70,000 in cash to make it an equitable exchange. So in the exchange, I debit my new building at the fair value of what I got. I get rid of my old building, credit the building for cash, debit accumulated depreciation for the balance of the accumulated depreciation as of the date of the exchange. Calculate the loss on the exchange, which was the difference between the fair value of the asset that I'm giving up compared to the book value of the asset that I'm giving up. And then either credit cash or debit cash. When would I debit cash instead of crediting cash?
If you were getting something for less value and they were paying you.
If I were getting something for less value. In other words, what if I was the one getting the $630,000 loft and was giving up a $700,000? No, and yeah, I was giving up a $700,000 loft and getting a $630,000 loft. Then would I receive 70,000 or pay 70,000?
Receive.
I would receive 70,000. And then what would I debit building for?
630,000.
Good, 630. 630. Now, when we retire, that means that we just throw it in the garbage. You know, we're not going to get anything for it. We just put it in the junk pile. Now, obviously, this is, you know, dramatic. And that Bostic just gave up. She decided to retire, to hell with it, put a padlock on the loft and just abandon it. Now, she wouldn't really do that. She would sell it. But just to show what the journal entry for retirement would look at is still record depreciation up to the date of retirement. Then what did I get? Did I get anything when I just abandoned it? No, didn't get anything. But what do I no longer have?
Building.
The building. So good. I got to credit it for 750, debit accumulated depreciation for 96,250. And the loss on retirement equals the book value. So when you have a retirement, your loss on retirement will equal your book value. Now I will, actually I've already prepared the problem. I'm working on the solution right now. I will put out into course content information a problem like this where you have to calculate what are the journal entries for selling it, exchanging it, retiring it. Okay, so I've already written it. I just need to do the solution on it, and then we'll be uploading that. The interest capitalization one for Colby is already uploaded. I want you to go to page, in chapter 10, go to page 534. And exchanges begin on page 531. Exchanges begin on page 531. And there's a summary on page 534 of how to handle exchanges. The example that we just did is an exchange with commercial substance. With commercial substance. When you have an exchange with commercial substance, you recognize a loss, you recognize the gain. Now, if you have an exchange that does not have commercial substance, what does commercial substance mean? You learned this in chapter 6. Remember, in order for it to be a contract, step 1 of the 5 steps, the contract had to have commercial substance. What does commercial substance mean?
The value of whatever asset you're getting. It's substance.
Well, it's more specifically defined as that the seller is going to expect a change in future cash flows. so that there is going to be a change in the future cash flows. Look at what happened. Let me give you an example. Say that 75 years ago, I bought a piece of land in Manhattan. And I've just left it as undeveloped land, unheard of, but undeveloped land in Manhattan. And I bought it 75 years ago for $50,000. Now, I can exchange it. Well, I can sell it or exchange it or retire it. I wouldn't want to retire it. I can sell it or exchange it at its fair value. And say that the fair value is $1 million. So this company has got land on its balance sheet under US GAAP at $50,000. Under US GAAP, all long-term assets are on the balance sheet at cost. At cost. So this land would be on the balance sheet at $50,000, although it is has a fair value of $1 million. Well, say this company needs their assets to be higher, their income is not looking great, so they need to boost income. So they get into a deal with someone and they said, you know what? Here's some land in Manhattan, and this person wants the land in Manhattan. And so I said, you know what? I'll exchange this land in Manhattan for some land just outside in the burbs somewhere, because I'm just holding on to this land for corporate offices, and it doesn't matter where my corporate offices are. I don't need for them to be in Manhattan. So I exchange this land, and it's going to have no commercial substance for it. The only reason that I'm exchanging this land is because I want to do two things. One is, when I exchange the land, at what value would the new land be on the balance sheet at? It's currently on my balance sheet at how much? What's my cost?
50,000.
50,000. And what if the land, it was an even exchange. It was an even exchange. The fair value of the land that I gave up is $1 million. The fair value of the land that I got is $1 million. Now the land would be on my balance sheet at what amount?
$1 million.
1 million.
Exactly, $1 million. And would I have a gain or a loss from the exchange?
Gain.
A gain of how much?
$950,000.
$950,000. So this company was able to get into an exchange that had no commercial substance at all, and have now an asset on their balance sheet of $1 million instead of 50. And on their income statement, they would have a gain of $950,000. Pretty cool, isn't it? When all they did was have a non-commercial substance, non-commercial reason for exchanging the land. All they did was get the asset onto the balance sheet at a higher amount and recognize a gain. So GAAP, this did actually happen, where companies started just getting into these exchanges. And the whole purpose was just to get assets on the balance sheet at a higher amount and retained earnings up, because net income is up. So then they came up with these rules that if there is an exchange that does not have commercial substance, okay, lack of commercial substance, what happens to the gain? what happens to the gain?
You're saying if there wasn't a commercial substance,
No commercial substance, so it
wouldn't
lacks.
it not be a gain then? Like we wouldn't recognize it? Is that what you're saying?
Exactly. GAAP says that if there is no commercial substance, you cannot recognize the gain. That the new asset would come on at the value of the old asset. It stopped that practice. Like there was a loophole in the accounting record, in the accounting rules that companies were taking advantage of, and they closed that loophole up. They said that if you have a gain, too bad. You're going to recognize the new property at the value of the old property. Now, what if I had a loss?
Same thing.
Nope.
Oh, really?
Nope. It
Recognized?
says don't recognize the gain, but you must recognize a loss. Here we see conservative accounting coming into play. So do you see where it says lack commercial substance? And record the gain or the loss. Where it says lack commercial substance, it says recognize entire loss. And then you have to calculate the gain to be recognized. And there's an asterisk. And I don't want you getting into all the complications of it. The gain is limited. The amount of gain that is limited to the amount of cash exchanged. I don't want you getting into the calculations of determining how much would be limited, okay? But what I want you understanding with exchanges is that if the exchange does have commercial substance, recognize the gain or loss, just like we did on the exchange that we just worked. If it does not have commercial substance, you recognize the full amount of a loss. The amount of gain that you recognize with no commercial substance is very limited. Okay? So that's what I want you understanding about exchanges. Differentiate, God bless you, between with commercial substance and without commercial substance.
I feel like that's not fair to a company though, right? Like if they're saying that under GAAP, it's like, won't recognize the gain, but will recognize the loss. Like I feel like it's an either or thing.
Well, yeah, but this is conservative accounting coming into play here. And they're saying that if there is no commercial substance, then we don't want you to overstate assets and overstate income. And that's just conservative accounting. And I agree with you. But what it did was it stopped that practice of that loophole of people starting to exchange property simply to get the asset at a higher price on the balance sheet and to be able to recognize the gain. It stopped that practice. Okay. So disposals, know how to record I sell it, I exchange it, I retire it. Now you're going to only have to do the journal entry as if it's an exchange with commercial substance. You only need to know in theory if it is an exchange without commercial substance. And the theory is recognize the gain, recognize the loss, the full amount of the loss, but the amount of gain that you recognize without commercial substance is very limited. It's very limited. And I know, Matt, it seems like it's not fair, but remember, it was closing up a loophole of a practice that people were doing to game the system.
Right.
Okay. All right. Before we end, and then you will see we've got impairments to do, and then we need to theoretically talk about revaluation on Thursday. Okay, and then we'll get into review. Make sure that you have, I know on the impairments are not difficult. Understand the two types of impairments, those on assets that are depreciated or amortized, those that aren't. And then I want you also calculating the impairment under IFRS. You have to know how to calculate impairment under US GAAP and under IFRS. They're different. Okay, so make sure that you understand those. Let me send out real quick a let me just send out this one. This one is just a concept. All right, I'll give you about 10 more seconds. Five, 4, 3, 2, 1. And the answer is that the seller recognizes a gain or loss for the difference between the cash received and the book value, not the fair value, the book value. Remember, a gain or loss is selling price minus the book value. You compare it to the book value. All right, so get some practice in. Start practicing for the exam. I will send out what the Zoom link is going to be for the office hours the day before the exam. So I will be sending that out. I'm going to upload a problem on practicing selling assets, exchanging assets, retiring long-term assets. And then we will look at retirements and the concepts of revaluations. Okay? Peace
Very
out.
good.
Are y'all tired?
Yeah.
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 Tired of being lazy?
I just want to go back to living.
Do what?
I just want to go back to living, you know, going outside.
No, me too. Yesterday, I spent 5 hours working on the thing. Yesterday, my mom had her cancer surgery. So I was involved with that, you know, because they had delayed her cancer surgery because of COVID, and they had a lull in the hospital. And so they brought her in and thankfully did her cancer surgery yesterday. So anyway, got that going on. But, and then I am working on the exam. I plan on having the exam finished before Thursday so that we can efficiently review for the exam based on the way that online questions are asked. Okay?
Very good, thanks.
Send me your presentation questions. You're welcome. So I'll be available to y'all, and then if not, forward to me your participation in doing the faculty evaluation so that I can keep track. I'm keeping an Excel list of it. Okay.
Oh, we get extra credit for that, for doing the survey?
Yeah, that's part of your participation extra credit for doing the survey.
Oh, hell yeah. All right.
Your participation thing.
Very good. All right.
Okay.
Thank you.
Thank you.
Oh, great. I appreciate you doing it, and then just send it to me and I've got it going in Excel file. All right. See y'all on Thursday.
Bye.
Bye-bye.